The brutal truth of speculation is this: your greatest enemy is not the volatility of the market, nor the cunning of the big operators. It is something far more intimate. It is the inescapable, gnawing psychological necessity to do something. It is the inherent, destructive need for action. You are paying a daily premium for the delusion that constant activity equates to profit, that movement equals progress. This is a deep affliction of the speculative mind. The amateur believes that if the market is open, he must be involved. He views money sitting idle as opportunity lost. He confuses trading with entertainment. He feels a compulsion, a genuine physical need, to press the button just because the tape is running. This urge to trade, to force a transaction where none is naturally occurring, is the single greatest destructive force on your capital. It is a tax you levy upon yourself. I have witnessed this destruction countless times. I have paid this tax myself early in my career in sums that would stagger an ordinary man. You must internalize this now. The market pays you to be right. It does not pay you to be active. We are here to master the infinitely more difficult and exponentially more profitable art of strategic inaction. This is the control that separates the professional speculator from the hopeful gambler. The control to sit absolutely still until the perfect moment arrives. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The greatest obstacle to strategic waiting is often the impatience that exacts a severe market penalty, a high cost of instruction most traders pay repeatedly with their own capital. Rather than learning solely through this painful expense, the foundational text for mastering non-reactionary discipline remains the 1923 masterpiece, Reminiscences of a Stock Operator, where Edwin Lefebvre meticulously recorded the hard-won philosophy of the legendary Jesse Livermore. Reading the accounts of Livermore is not merely historical study. It is entering a practical training ground, allowing you to absorb decades of wisdom and pay the cost vicariously. To ensure this century-old guidance is fully applicable to modern volatility, the crucial text is the Max Davidson Annotated edition, which provides the critical commentary necessary to bridge the gap between 1923 methodology and contemporary execution. If you are serious about minimizing your unnecessary market expense, a link to this essential edition is provided in the description below. We begin with the understanding of what you are actually fighting when you force a trade. You are fighting the certainty of arithmetic erosion, the cost of constant movement. Understand that every single transaction you initiate carries a guaranteed cost. It is a commission. It is a bid/ask spread. It is slippage. It is a minor, almost imperceptible tax levied on your equity, paid directly to the machinery of Wall Street. Most men view this cost in isolation. They look at a single 100-share commission and deem it negligible. This is a catastrophic error in judgment. The professional must look at the aggregate cost. The total tax accumulated by 200 unnecessary transactions over the course of a market year. The damage is not inflicted by the occasional, well-researched error. The true damage is inflicted by the constant movement, the sheer volume of small, meaningless trades forced out of nothing but impatience. This is death by 1,000 cuts. Each minor trade forced by the itch to be involved nibbles at your working capital. These small, unnecessary losses erode the psychological edge as surely as they erode the bankroll. You begin to resent the market. You begin to feel the desperate need to recoup those small accumulated transaction costs. This manufactured desperation leads directly to Block 6, the deadly mistake of reactionary trading. Strategic waiting eliminates this self-inflicted tax completely. If you make 10 trades a year instead of 100, you save the cost of 90 trades. That saving is pure realized profit. But the cost of constant movement is far more insidious than just brokerage fees. It is the cost of mental fatigue. Every time you commit capital, you commit mental energy. You attach emotion. You start the clock on your worry. The amateur is exhausted by the time the major opportunity finally presents itself because his mind is cluttered with a dozen minor, meaningless commitments. He is spent. He has used up his discipline on trivial positions. The professional holds his mental capital sacred. He preserves it by refusing to commit it until the odds are overwhelmingly in his favor. He understands that the aggregate loss of small, unnecessary trades ultimately outweighs the occasional big mistake he might make on a major position. You cannot afford to bleed capital in these minor amounts. You must treat your money and your focus as finite resources to be deployed only in situations of high certainty. If the setup is not clear, the cost of action is too high. You pay the financial tax, and you pay the psychological tax. Refuse to pay them both. Wait. The professional posture of idleness. Most men believe that work is movement. They believe that if they are sitting silently, they are failing. This is the mindset of the laborer, not the speculator. In speculation, strategic patience is not laziness. It is, in fact, the most intense, demanding form of disciplined work that exists. Your desk is your battlefield. Your stillness is your armor. The real work of a speculator happens far from the trading screen. It happens in the quiet hours of research, observation, and calculation. The execution of the trade is merely the final, easy step. The hard work is the waiting. I may go weeks, sometimes months, without initiating a significant position. In the eyes of the amateur, these are periods of inactivity. They are wrong. These are periods of intense, strategic defense. The market provides obvious opportunities only a few times a year. Your goal is to capture those few, massive moves. The rest of the time you are standing guard over your capital. This waiting period is where true profit is established. While you are waiting, others are destroying their capital through impatience, chasing shadows, and paying the transaction tax. You are preserving yours. You are letting them exhaust themselves. When the market finally aligns, you are fresh, well-funded, and ready to strike with maximum conviction. They are already battered and short on nerve. The man who sits idly for 6 weeks and then makes one powerful, decisive trade based on irrefutable evidence is working harder and more profitably than the man who attempts 5 trades every single day. You must cultivate the professional posture of idleness. It is a posture of readiness. It implies that you are viewing the market as a hunter views the woods. He does not scatter shot wildly. He waits for the deer to step into the clearing. He knows the cost of movement. He knows the value of stillness, waiting for the market's confirmation. This is the fundamental, non-negotiable rule of non-reactionary trading. You must never anticipate. You must wait for the tape to confirm your hypothesis. Your opinion is utterly worthless until the market validates it. Every man who has ever been slaughtered on Wall Street has done so because he substituted his personal opinion for the evidence provided by the price action. He decided that a stock should go up. He decided that a stock must be too expensive. This is speculation rooted in ego, not business rooted in fact. Trading based on what should happen is a philosophical exercise destined for the poorhouse. Trading based on what is happening, as confirmed by the hard facts of the tape, is business. I have no concern with what the price should be. I care only what the price is, and more importantly, what the price is doing. This waiting for confirmation means refusing to jump in prematurely. The stock begins to climb. The amateur rushes in, afraid of missing the move. He buys before the stock clears its resistance level, betting on the future. The stock pulls back sharply just under the critical pivot point, sweeping out all the impatient money. The professional waits. He is not afraid of paying a slightly higher price after the stock has definitively moved beyond the resistance. He pays the premium for certainty. He waits for the critical signal, not the suggestion. If you are buying a stock because it looks cheap, you are acting on anticipation. You are trading on hope. The definition of a stock that looks cheap is usually a stock that is determined to become cheaper still. Wait for the market to tell you it has finished descending. Wait for the sustained reversal. The market will give you plenty of time to get in after the confirmation. The initial move, the sudden jump, is rarely the main event. It is merely the opening curtain. The impatient man jumps at the opening curtain and misses the play entirely. Wait for the irrefutable evidence. Wait for the commitment. When the market confirms your theory, it is no longer a theory. It is a working hypothesis, backed by the movement of millions of dollars. That is the only time to act. The big money is in the main move. The great temptation for the active trader is to get involved in the daily fluctuations, the minor tremors and wiggles. The tape runs and the mind starts inventing trades. He sees the stock move 2 points and thinks, aha, 2 points, I must capture that. He fails to see the 3 major sustained trends that will define the year. He has traded away his vision for micro-profits. The non-reactionary trader trains himself to ignore the meaningless noise. The big money is not made in catching every single shift in sentiment. The big money is made in identifying the overarching movement of the entire market or the entire group. You must ignore the day-to-day chatter. It is a distraction, engineered by those who thrive on commissions. If I am short 10,000 shares of a railroad stock because I believe the entire sector is headed for contraction over the next 6 months, I do not care if that stock rallies 3 points next Tuesday. That rally is noise. It is irrelevant to the main tide. The amateur panics on that 3-point rally. He reacts instantly. He sells, protecting a small profit or minimizing a small loss, effectively cutting the line that connects him to the enormous profit potential of the main move. The professional speculator uses strategic weighting to endure these trivial fluctuations. He knows that if his fundamental premise, the major trend, is correct, the market will eventually overwhelm the noise. You must step back and see the forest, not the bark on a single tree. What is the line of least resistance? Is the entire market heading north or south? If you are correctly positioned for the main tide, minor retreats are your opportunity to reaffirm your conviction, not your signal to react and retreat. Reactionary trading forces you to be constantly involved, constantly nervous, and constantly focused on the smallest unit of price movement. Non-reactionary trading gives you the immense mental space to focus only on the grand current. The main move is where fortunes are built. The minor fluctuations are where they are lost. Choose your focus. The opportunity cost of non-existent opportunity. The greatest discipline, perhaps greater even than cutting a loss quickly, is recognizing when the market simply does not present an intelligent opportunity, and then doing nothing. The market is not an endless fountain of chances. There are periods of abundance and there are deserts. The amateur dies in the desert because he attempts to manufacture water where there is none. He must trade. He feels compelled to justify his time spent watching the tape. He finds an excuse for action. This is the opportunity cost of non-existent opportunity. It is the cost of taking a poor trade now instead of waiting for a certain trade later. The truth is that sometimes the market is flat. Sometimes it is indecisive. The forces of buoyancy and depression are temporarily balanced. The stock moves sideways. In this indecisive phase, the market is designed to slaughter the impatient, leveraging the speed of its unpredictable whipsaw movements against the man who must be active. If the market gives you no clear direction, the only profitable action is absolute stillness. Do not try to force a break. Do not try to predict which way it will shatter. The cost of being tied up in an aimless, directionless stock is enormous. Your capital is stagnant. Your emotional energy is depleted. And crucially, you are unable to take advantage of the real opportunity when it finally materializes in another sector entirely. Your greatest asset is your dry powder, your uncommitted cash. When you commit capital to a mediocre manufactured trade, you are paying the highest cost. You are removing your ability to act decisively when the setup is perfect. Refuse to manufacture excitement. Refuse to trade for the sake of the ledger. If the market is closed to intelligent action, then you must be closed for business. You are a speculator, not a retailer obligated to keep his doors open. The market will wait for you. You must have the conviction to accept weeks of absolute idleness, knowing that you are protecting your future strike capability. This is the patience of the predator. He conserves his energy until the moment of guaranteed kill. The danger of emotional averaging down, the panic reaction. If there is one reactionary move guaranteed to destroy a speculator faster than any other, it is the immediate emotional attempt to recoup an instant loss. This is not speculation, this is pure, unadulterated revenge trading. You take a position. The market immediately moves against you. Your initial reaction is one of panic and wounded ego. How dare the market tell you that you are wrong? You feel the compulsion to double down immediately, or perhaps instantly reverse the position, hoping to nullify the initial error with a swift, compensating win. This is the moment the professional must assert absolute control. The market does not owe you a recovery. The market does not care if you are back to even. When a trade goes immediately wrong, the market has delivered a powerful, immediate piece of evidence. Your timing or your premise was incorrect. The correct non-reactionary response is withdrawal. Retreat completely. Liquidate the failing position. Accept the small defined loss instantly. Then, and this is the critical step, you must strategically wait. Wait until your emotional temperature has dropped back to absolute zero. Wait until the failed trade is a clinical memory, not a burning insult. You must reassess the market from a detached perspective, completely unburdened by the desire to get back what you lost. The impulse to average down is fatal because it is purely emotional. It takes a small, manageable loss, a 2-point loss on a small test position, and turns it into a desperate, sprawling commitment when the stock hits 6 points against you. You are reinforcing failure. You are throwing good money after bad simply to satisfy the ego's need to avoid being wrong. Never attempt to recoup a loss in the same day, or even the same emotional state in which the loss occurred. Wait for the next unrelated clear opportunity. Wait for the market to give you a new, pristine setup, utterly divorced from the emotional wreckage of the previous failure. Strategic waiting prevents the cascade failure. It forces a pause between error and action, allowing logic to return. You must not react to failure by doubling the bet. You must react to failure by folding your hands and waiting for the deck to be reshuffled. The observation post mentality. Trading success is fundamentally a matter of perspective. The speculator must maintain a detached, clinical perspective, a high vantage point. I call this the observation post mentality. You must view the market like a general viewing the battlefield from a secure, distant post. You see the entire scope of the action. You see the movement of the large battalions. You note where the enemy is strong and where he is weak. This distance is essential. The moment you begin reacting to every small market movement, every tick, every rumor, every minor shift, you have left the observation post. You have rushed down into the trenches. In the trenches, you cannot see the main battle. You are blinded by the mud, deafened by the immediate noise, and focused only on the fight directly in front of your face. This is emotional entanglement. Reactionary trading pulls you into the trenches, forcing you to fight every skirmish. You lose sight of the strategy. The observation post requires strategic waiting. You wait for the reports to come in. You wait for the lines to clarify. You wait for the overwhelming, decisive opportunity to deploy your entire force. If you are constantly trading, you are constantly emotionally invested in the minor outcomes. You lose your clinical objectivity. A good trade requires detachment. It requires a cold, rational assessment of probabilities, uncolored by hope or fear regarding the capital already committed. How do you maintain this detachment? By trading less, by waiting longer. The distance achieved through strategic inaction ensures that when you finally do pull the trigger, the move is a planned execution, not a panicked reaction. You must treat your capital like troops. You do not send them into skirmishes you cannot win decisively. You preserve them for the major offensive. Keep your distance. Maintain the high ground. Wait until the view is absolutely clear. Patience in the profitable position. Strategic waiting is not just a virtue of entry. It is a necessity for exit. Many speculators manage the difficult feat of identifying the main move and successfully initiating a position, only to destroy their potential profit through premature reaction. They enter the position. The stock begins to climb. They watch the paper profit materialize. Then the stock experiences a normal minor pullback, a healthy momentary correction within the larger trend. The amateur reacts instantly. He sells out of fear. He rushes to lock in the profit he has already secured, terrified that the market will snatch it back. He confuses a rest stop with a reversal. He cuts his profits short because his fear of losing paper money is stronger than his conviction in his original analysis. The market never moves in a straight line. It ebbs and flows, testing the conviction of the men holding the shares. Strategic waiting here means having the discipline to sit through the minor pullbacks and allow the profit run to materialize fully. You must understand the difference between noise and signal even when you are winning. The primary trend is your signal. The minor day-to-day dips are the noise designed to shake you out. If the underlying conditions, the fundamental forces driving the major move, have not changed, then your position must not change. You are waiting for the market to signal its definitive end to the trend, not just its temporary fatigue. The professional does not sell simply because he has a profit. He sells because the tape confirms that the uptrend is over, or that the line of least resistance has reversed. If you are selling because you are nervous about seeing your profit shrink slightly, you are reacting emotionally. You are allowing the market to set your pace. The big money is only realized by holding positions for the full extent of the move. This requires immense non-reactionary patience. You must learn to tolerate the sight of your profits receding slightly, knowing they will swell greater still, provided the main trend remains intact. Let the market tell you when it is done. Do not preempt it. The power of the pivot point. My success, especially in handling large lines of stock, was defined by a specific form of technical waiting, the waiting for the pivot point. The pivot point is a critical price level, a confirmed line of resistance or support, which, when decisively crossed, signifies that the stock has committed itself to a new direction. It is the point where the line of least resistance has been unequivocally established. I rarely entered a trade until the price crossed this pivot point. This was my final signal of confirmation. The amateur rushes in far too early trying to anticipate the break. He operates in the murky middle ground. The murky middle ground is the trading range where stocks whip back and forth, burning impatient capital through minor losses and emotional frustration. It is where no clear direction is established. The professional waits for the declaration. If the stock is trading between 90 and 100 for 3 weeks, the pivot point is 100.01 or perhaps 89.99. I'm perfectly content to sit idle watching the stock bounce between 92 and 98. This action means nothing to me. It is testing the weak hands. When the price definitively clears 100, when it trades at 100 and holds 101, and then pushes to 102, the market has given its confirmation. The line of least resistance is now upward. By waiting for the pivot, you pay a slightly higher price than the earliest buyers, but you drastically reduce the uncertainty. You avoid the exhausting, capital-draining swings of the middle ground. Waiting for the pivot is the ultimate expression of non-reactionary discipline. It forces you to ignore the daily chatter and focus only on the grand signal. If the stock fails to reach the pivot, it simply means the time for action has not arrived. No trade is better than a poorly timed trade. The pivot point is your stoplight. When it is red, you are idle. When it turns definitively green, you act instantly, decisively, and with maximum force. You wait for the signal, do not guess the color. Time as the ultimate leverage. Finally, we must revisit the concept that time is not merely a duration to be endured. Time is capital. Time is your ultimate leverage. The non-reactionary trader uses time strategically. He allows the market dynamics to develop fully. He allows the movement to prove itself correct before he commits his resources. The greatest advantage held by the independent speculator is his freedom from the necessity of action. He is not forced to trade to justify a salary or meet a daily quota. He is free to wait. The speculator who trades 2 times a month instead of 20 times a month is leveraging time. He is trading less, thinking more, and allowing his judgment to ripen fully before he risks his capital. The impatient man uses financial leverage, borrowed money, to try and speed up the process. This leverage amplifies both his wins and his inevitable frequent losses. The professional uses the leverage derived from patience and deep conviction. Conviction is the reward of patient observation. You cannot have deep conviction about a position you entered on a whim 15 minutes ago. You can only feel panic. But if you have spent 6 weeks observing the market, watching the trend develop, testing your hypothesis against the noise, and finally waiting for the irrefutable pivot point, your conviction is absolute. That conviction allows you to endure the minor pullbacks, ignore the rumors, and hold the position until the profit objective is fully reached. It allows you to use time to your advantage, letting the natural accumulation of momentum work for you rather than against you. The speculator who understands time as leverage is fundamentally secure. He knows that if he misses this opportunity, another one will materialize in due course. He does not rush, he does not chase. He operates on the timeline of the market, not the timeline of his own impatience. This perspective is the foundation of mental control. You must internalize that the minutes you spend waiting are often the most profitable minutes of your entire career, because they are preserving your capital and ripening your judgment. Let the others rush. Let them pay the tax. You will sit still, leveraging time and patience until the odds are fixed overwhelmingly in your favor. The market rewards control, and control is born from stillness. You cannot master the tape until you have mastered the man holding the order pad. That man is you. Do not mistake action for progress. Do not confuse the activity of the broker with the discipline of the speculator. The goal is not to trade often, the goal is to trade well. True mastery is the deliberate, strategic decision to fold your hands and wait until the certainty of the movement makes action a near formality. This is the ultimate lesson of the trading floor. The greatest profits belong not to the swift, but to the strategically patient. The greatest failures belong to the men who could not sit still. Be the man who waits. Be the professional.